Hey guys, what's up? Spenny here. So in today's video, I'm covering Apex Technology Acquisition Corp. This is a highly requested SPAC by you guys. This is trading at $16 right now, up from about $10 just a couple of months ago. So that's about a 60% return. But in this video, I'm going to project out the revenues and show you guys what kind of return on your investment you can get. And I'm really surprised. This is actually a really good buying point, even at $16 a share. I'll show you guys exactly what I mean. Make sure to watch till the end if you're interested in seeing that price prediction. Anyways, guys, make sure to drop this video a big thumbs up and make sure to subscribe if you want to see more content like this. I do cover stock videos almost every day of the week. And make sure to check out that WeBull link down below in the description. If you sign up with WeBull using that link and deposit just $100, you'll get 4 free stocks. Anyways, let's dive straight into this, guys. So AvePoint and Apex Technology Acquisition Corp will combine to create a publicly listed company with a $2 billion market capitalization. Now, this is important because I will be valuing this company, but that $2 billion market cap is at $10 a share, not $16 a share, so we also need to account for that. So anyways, guys, let's move on to the next slide here. So in this slide, it shows a little bit of what they do. Essentially, they help big organizations manage their data. This isn't like Snowflake, it's quite a bit different. One of their main partners is Microsoft, and that's what's getting a lot of people excited about the stock. It has me excited, but I'm actually more excited about its valuation and its projected revenues. I think that's really impressive, and its margins as well. Everything about its fundamentals is great with this company, but they're in the data space, guys. This isn't a Snowflake though, so don't get those things mixed up. But continuing on, so AvePoint is the leading data management solutions provider for the Microsoft Cloud. This is really important. Microsoft is, one of the biggest tech companies in the world. So this brings a lot of credibility to AvePoint, in my opinion. Kind of takes away a lot of that speculation. And it is also a massive total addressable market. The TAM growth is going to be $33 billion by 2022. So if they can even get a small piece of that pie, there is tons of growth ahead for this company, and I don't think they're going to have a problem growing. We'll get into their expected growth rate in a second. I think it's actually really realistic. I don't think they're misleading investors in this presentation, which is really nice to see. A lot of SPACs that have come public this year are pre-revenue and really misguiding investors. I'm not going to get into that, but this company is actually more credible, and yeah, we'll get into it, guys. I like this one a lot though. So going off of that credibility, they are massively diverse. You can see all of the blue chip customers they have. And the nice thing about this is in several different industries. As you can see here, it's in communications, retail, pharma, financial services, government, and high technology. So yeah, to me, this just helps take away that risk by investing in the stock. They are well established and they have a lot of credible, big, meaningful companies. That's something I like to see when investing into a brand new company hitting the market. The two concepts I always preach, or not always preach on this channel, but I do preach once in a while at least, is proof of concept and ability to scale. To me, their proof of concept is down. I mean, they're partners with Microsoft, and their ability to scale is clearly there if they're with that many big blue chip companies. So this isn't a super speculative play. And getting into the exciting stuff, their revenue growth. So the revenue growth is actually really impressive, and what's more impressive is the reoccurring revenue. So you can see here that they're expected to grow at 30% year over year, and their reoccurring revenue is expected to grow at 38%. So more and more of their revenue over time is going to be reoccurring. This is an absolute beautiful business model. It's high margins, it's reoccurring, it's really easy to project their revenues out and get an idea of what kind of return we can get on our investment. And then moving on to this slide, there's just 3 things I want to show you guys. You can see on the first underline is their growth rates between 26 to 33%. The next line that I underlined is their percent of revenue that is going to be reoccurring. You can see this is going from 71% all the way to 85% over just the next couple years. I love to see this. And another great thing is their margins. So the bottom line, their margins expected to grow from 69% to 74%. So all of these numbers are great. I'm really hoping that they can actually hit this. So I want to move on to his revenue projections, guys. But first, we need to compare this to some other company to know what premium this stock is going to trade at. And by premium, I mean price to sales ratio. With growth stocks, it's a really accurate way to project on what kind of return you can get. I'm going to compare this to Slack. They both have similar growth rates, similar margins. They're both very specialized in what they do. So I think that this is a pretty fair comparison. And given that APOINT is expected to grow around 30%, it really should have about a 20 price to sales ratio in my opinion, especially considering how much of the revenue is reoccurring and how high their margins are. Slack has historically traded between, a 23 to 28 price to sales ratio. 28's on the high end because it's absolutely popped since it's being acquired. Normally it trades around 20. So for my projections, I'm going to give APOINT a 20 price to sales ratio. So looking here, we can see the current share price is $16. Its market cap is $3.2 billion when accounting for that 60% appreciation it's seen in its share price. And it has a current price to sales ratio of 21. So that's right at its fair value that I would give it. I'm going to go off a price to sales of 20, but I'm actually quite surprised to see a SPAC trading at a 21 price to sales ratio considering it's appreciated 60%. I really wish I noticed this company when it was trading at $10. I would have definitely bought up a lot of shares. However, even at today's price, I think it's still a great buy. Let me show you guys why that is exactly. So all of these projections is going to be based off that 20 price to sales ratio, guys. In 2023, with a 30% revenue gain, we'll have 335 revenue. That would bring us a market cap of $6.7 billion and a share price of $33. So by 2023, we could actually double our money. It gets a lot more exciting though. If we go to the year 2024, same revenue gain, that would bring us 440 revenue and a market cap of $8.8 billion and a share price of $44. And then in the year 2025, we should bring in around 580 million. That would give us a market cap of 11.6 billion and a share price of 58. That's a 3.6x return on our investment in just about 4 years. That is really impressive, especially considering this is a brand new SPAC. Usually that's just not how the math works out when I do these projections. So I'm pretty shocked, but I'm not surprised. I really like this company. But we do need to account for share dilution. So if we throw in 30% share dilution by the year 2025, that would give us a share price of $41. That's still a 2.5x return though, guys. This is really realistic. This is not aggressive at all in my opinion. If we manage to grow at say 40%, I mean, you can see a lot higher share price by the year 2025. But even if we grow around that 30% that they're projecting, it's hard to imagine a scenario where you don't make money by investing at $16 today. Even if something really went wrong in this model and it only deserves a price to sales ratio of 10, you're still gonna make money even at that. But I think that's really unrealistic. I don't think it's gonna be trading at a price to sales of 10. But I mean, that's like worst case scenario and you're still not losing money. So this is a really low risk stock in my opinion and pretty decent reward. It's not a super speculative play or anything like that. And it's just easy to project out its revenue. So anyways, guys, that's my thoughts on this one. I really like this stock. I probably will buy shares very shortly. I'm gonna see what the market does when it opens up tomorrow. I'm also looking to buy into shares on Alibaba, as I said in my previous videos. Alibaba has recently dipped massively and I wanna take advantage of that. But this is another one that I wanna get into too. So I'll probably get some skin in the game ASAP and I'll let you guys know when I do that. Anyways, I hope you guys enjoyed this video. Thanks for watching till the end. Really appreciate that. I'll see you guys in the next one.